Hey there. Ready to jump into the world of ultra-high-yield dividend stocks? You know those tempting payouts that, well, they sometimes seem a little too good to be true, right?
Yeah, tempting is one way to put it.
So today we're going to take a closer look at two big American companies, Ford and Pfizer, and see if their sky-high yields are the real deal or maybe just a clever disguise.
It's a bit like, panning for gold. You get all excited about that glittery potential, but you got to sift through a lot of dirt and gravel to find those nuggets. You know what I mean?
Okay, I like that analogy. And sifting we shall do. But just to set the stage for anyone new to dividends, Hartford funds, they've shown that dividend stocks, historically at least, they've outperformed their non-paying counterparts.
Right, over the long haul, for sure.
Yeah, which makes them worth a closer look. But here's where things get really interesting. We're homing in on what they call ultra-high yield stocks, those offering dividends at least 4 times higher than the S&P 500. And that's where we really need to put on our analyst hats.
Exactly. Because, yeah, those fat dividends can be alluring, but they can also be a red flag.
How so?
Well, sometimes a company that's struggling, to stay afloat, they'll offer a juicy yield just to attract investors and kind of mask deeper problems. It's that classic case of too good to be true.
So how do we separate those diamonds in the rough from the potential yield traps?
That's our mission today. We'll be digging into the fundamentals, looking at the company's financial health, their growth prospects, and their ability to actually sustain those enticing dividends over the long term.
Music to my ears. All right, let's get down to business. We'll start with Ford. Bank of America analyst John Murphy, he's put a $20 price target on Ford.
Yeah.
Which, when you factor in their $1.60 annual dividend, translates to a 92% potential return over the next year.
Wow.
Almost double your money. Sounds pretty tempting, right?
It certainly gets your attention.
It does.
But before we get too far ahead of ourselves, let's remember Ford's been navigating some choppy waters lately. Their warranty expenses have been eating into profits, and the electric vehicle market hasn't quite taken off as they might have hoped.
Right. It hasn't exactly been a smooth ride. So what's the bullish case? What makes Murphy so optimistic about their future?
Well, he's banking on a few key factors. First, Ford's shown a willingness to adapt, which is, essential in this industry. Remember that $12 billion in EV spending they decided to postpone?
Yeah.
That tells me they're being strategic, not just blindly throwing money at a trend.
It's like tapping the brakes, not slamming them on their EV production.
Exactly. They're keeping their options open and responding to, actual market demand. But even as Ford navigates this EV transition, we can't forget about their bread and butter, that legendary F-Series pickup truck.
Oh, yeah.
It's been America's best-selling truck for, almost half a century, consistently dominating a very, very profitable market.
It really is the engine that keeps Ford running, isn't it? There's a certain, mystique that comes with owning an F-Series. People swear by them.
Absolutely. And it's not just about brand loyalty. There are signs that Ford's quality control is improving under CEO Jim Farley. They've been climbing the ranks in the J.D. Power initial quality study, which bodes well for reducing those pesky warranty costs down the line.
So we've got strategic flexibility with their EV approach, what'd you call it, a cash cow?
A cash cow, yeah.
A cash cow in the F-Series, and improving quality control.
Yeah.
What else should we consider when we're evaluating their financial stability?
Well, for starters, their forward price-to-earnings ratio, or forward PE, is currently below 6. Now, this ratio essentially tells us how much investors are willing to pay for every dollar of a company's expected earnings. A lower PE often suggests that a stock is undervalued.
So in Ford's case, a forward PE below 6, that could be a signal to value investors that they're getting a good deal.
That's the general idea, yeah. It's just one piece of the puzzle, of course, but It's definitely something to keep in mind.
All right, we've covered a lot of ground with Ford, but before we get too comfortable cruising in our metaphorical F-Series,
right,
let's switch gears and head over to the world of pharmaceuticals with Pfizer. Cantor Fitzgerald analyst Louise Chen sees Pfizer potentially reaching $45 a share, which, coupled with their $1.68 annual dividend, points to a possible 60% return over the next year. Not quite as eye-popping as Ford's potential 92%, but still nothing to sneeze at.
Not at all. However, we'd be remiss if we didn't address the how do I put this? The elephant in the room, the so-called COVID hangover that's been impacting Pfizer's recent performance.
Right. Pfizer became a household name during the pandemic, but now that demand for COVID-19 vaccines and treatments has, it's declined, and investors are wondering what's next.
Exactly. The key question is, can Pfizer sustain its growth even with this decline in COVID-related revenue?
That's what we're here to unpack. What does their post-pandemic future look like?
Well, the interesting thing is, despite the dip in COVID-related sales, Pfizer's overall revenue has actually jumped a significant 46% since 2020. This tells us they're not a one-trick pony.
That's a powerful counter-narrative. It seems like they're hitting refresh on their growth strategy, shifting from a pandemic-driven model to something more diversified and sustainable.
You've hit the nail on the head. And to understand this shift, we need to delve into their recent strategic moves, particularly their acquisitions. Remember that the $43 billion acquisition of Seagen?
Yeah.
It's all about expanding their oncology portfolio. Seagen, they specialize in antibody drug conjugates, which are basically highly targeted therapies that deliver chemotherapy directly to cancer cells.
So less damage to healthy tissue.
Exactly. Minimizing damage to healthy tissue, which is huge.
Which is huge.
It's a cutting-edge approach to cancer treatment.
So Pfizer's making a big bet on the future of oncology. But with a $43 billion price tag, that's got to have some impact on their bottom line, right?
Short term, absolutely. You'll see acquisition-related expenses cutting into their profits initially.
Right.
But here's the long game. Pfizer's banking on something called cost synergies.
Okay. And what does that mean?
Basically, they expect to find ways to reduce costs and improve efficiency by, integrating Seagen's operations into their own.
Okay, so it's about streamlining, finding efficiencies, and ultimately boosting their profitability down the line. But beyond the Seagen acquisition, what's driving Pfizer's their organic growth? You mentioned that their revenue is up significantly, even excluding the COVID products.
Right, and that's a really encouraging sign for their long-term prospects. If we just look at their recent quarterly results, even after stripping away all COVID-related products, their revenue still jumped an impressive 14%, and that's adjusted for currency fluctuations.
Wow, where's that growth coming from?
Well, a big chunk of it is fueled by their core oncology and specialty care portfolios.
Makes sense.
But here's what I find really interesting. They're also seeing double-digit growth in areas like internal medicine, inflammation, and immunology, and even rare diseases. This tells me they're successfully leveraging their research and development capabilities across a diverse range of therapeutic areas.
So it's not just about finding the next, blockbuster drug, right? It's about building a robust pipeline across multiple areas of medicine.
Exactly. They're playing the long game, focusing on sustainable growth rather than relying on a single product or market. And that brings us to another important metric for assessing Pfizer's financial health, their forward price-to-earnings ratio.
Right.
Remember, we discussed that with Ford.
Yeah, you explained how a lower PE ratio can often indicate a stock is undervalued.
Right. So Pfizer's forward PE currently sits at a reasonable 10.
Okay.
Now, that's a bit higher than Ford's. But it's important to remember, we're talking about two very different industries, with different growth profiles.
Right. The automotive industry, it can be cyclical, with sales often tied to the broader economy. Pharmaceuticals, on the other hand, tend to be, less volatile. People need their medications regardless of economic ups and downs.
Precisely. And that inherent stability is often reflected in the PE ratios of pharmaceutical companies. They're often considered, less risky, which can translate to a slightly higher PE compared to companies in more cyclical industries.
So taking everything into account, the Seagen acquisition, their organic growth, a reasonable PE ratio, it seems like Pfizer's taking concrete steps to navigate a post-COVID world. But how does this all translate to the individual investor? What should they be thinking about when they see that tempting 5.8% dividend yield?
That's the million-dollar question, isn't it? And this is where things get really interesting. We've looked at the numbers, we've analyzed their strategies, but ultimately, the decision to invest or not comes down to your individual risk tolerance and your investment goals.
That's such an important point. It's not just about chasing the highest yield. It's about finding investments that align with your, personal financial situation and your overall investment philosophy.
Couldn't have said it better myself.
Okay, so we've covered two very different companies, both offering those enticing ultra-high yield dividends. We dug into their financials. We dissected their strategies. We even pondered those all-important PE ratios.
It's been quite the deep dive,
Yeah.
but, this is just the beginning, right?
And that's the beauty of it,
Right.
right? There's always more layers to peel back, more factors to consider.
Absolutely. Take Ford, for example. We talked about, their strategic shift with EVs and their dominance in the pickup truck market. But what about like the global landscape? How will things like supply chain disruptions and or rising interest rates or even geopolitical instability, how will those things impact their operations?
Those are all crucial considerations. And with Pfizer, we dug into their oncology acquisitions and their efforts to diversify beyond those COVID-19 products. What about potential competition from generic drug manufacturers or the ever-evolving regulatory landscape for pharmaceutical companies? I mean,
Yeah.
these are all factors that can make or break an investment.
Exactly. And that's why at the end of the day, the most important takeaway from all of this, it isn't about picking a winning stock or anything like that. It's about, empowering you, the listener, with the knowledge and the critical thinking skills to make informed decisions, investment decisions that align with your own individual goals.
So as we wrap up this deep dive into ultra-high yield dividend stocks, here's something I want you to think about. Do Ford's turnaround efforts and Pfizer's, post-COVID strategy, do those resonate with your own assessment of the market? Do their long-term prospects, do they justify those tempting yields? These are questions only you can answer.
And remember, informed investing, it's an ongoing journey. It's not a destination,
Yeah.
Keep asking questions, keep digging deeper, and never stop learning.
Couldn't have said it better myself. Thanks for joining us on this exploration of ultra-high yield dividend stocks. Until next time, happy investing.